All right, disposing of AR and notes receivables. So how do we get rid of disposing them? Just means getting them off your balance sheet. So the most common way they are disposed of is by the holder transferring them for the cash owed, meaning, well, how do you get rid of AR? You collect the cash that's owed to you, and same with notes receivable. What about other transactions that could happen? Well, you could do a secured borrowing or you could do a sale of receivables. Now, let's say you've got $100,000 of receivables, but you have bills to pay today. So your customers, you're a manufacturing company, your customers owe you $100,000, but you need this cash today. Well, you could try to pester them to pay you today, but they might not. Likely they probably won't. They're not trying to pay you as quick as possible. They're trying to hold off as long as possible. Well, you could do a secured borrowing, and anytime you have a secured borrowing, that's when you're leveraging against something. So, if you have a house, that's a home equity line of credit. Now, what's the benefit of that? Credit cards have a super high interest rate because there's no collateral. If you don't pay your credit card, they can't really come after you and steal your house. The bank, not the bank, they could come get your house. But home equity line of credit, you get a super low interest rate because you're borrowing, let's say, $1 million against the value of your house. And if you don't pay this back, the bank can come in and just say, boom, I have a clear line of passage to have a claim on your house, and they could just take your house. So that's why if you're ever borrowing against something, it's better to borrow against something if you're ever borrowing money, whereas credit cards are super high interest because you're not leveraging against something. You could leverage against stocks, against automobiles. You can get collateralized loans. That's what we're talking about here. So just like those are all assets you're collateralizing against, you could go to the bank or some third party. I'm just going to refer to them as third party. There are companies that do this. And you could say, hey, I want to borrow money. And if I don't pay it back, you collect on my AR. Now, you probably won't get as good of a rate as a house because a house is a lot easier to seize than AR because then the company then has to go and get it from those other customers. So you're much more likely to get a better rate if you leverage your house or a physical asset, but you can still have a secured borrowing. You could also sell your receivables. So this is a factoring company. This is more so like there is a third-party company that does this. And think of it like a collections agency. You are a manufacturing company. What do you do well? You make things well. You don't necessarily collect from people well. Like that's not your strong suit, is to collect money from people. So with that being said, maybe you take a little bit of, you give them a cut, you give them a 4% cut. So maybe they give you, not even percentages, let's say they just give you, this factoring company gives you $85,000 in cash. And now that company has the right to collect this $100,000. So you've quote unquote lost $15,000, but maybe it's worth it to you because your company's not strong at collecting money from customers and you wouldn't have really gotten that much anyway. So it benefited you because you got your cash up front, and it benefited this third party company, this collection agency, because now they have the right to collect $100,000. So they made $15,000 profit. Those are two items, two options. You might not see direct questions of these, but just knowing they're out there because this is part of the business and what we'll see on our financial statements. Now, treatments for these, we've got on the secured borrowing, the holder of the AR retains ownership of the receivables, meaning, so you're the manufacturing company, you still own the receivables, you're just borrowing against them. But if you sell the receivables, you transfer the ownership of the receivable to the third party, to the company, to the collection agency. With secured borrowing, the original company, so the manufacturing company, still assumes risk of collection. But if you sell to the collection agency now has the risk of collection. Under secured borrowing, the transferred assets are not isolated from the transferor. And in the sale of receivables, the transferred assets, and this is the receivables, are isolated from the transferor. So basically, again, kind of more of the who owns them, who has ownership of them. So this one, the manufacturing company still has ownership. This one, the collection agency has ownership. Transferee does not have the right to pledge or sell assets. So meaning if you borrow from a bank, the bank does not have the right to sell your assets. They only have the right to take them if you don't pay your bills, if you don't pay your debt down. In this case, you gave your AR to the collection agency, so sure, they have the right to pledge or sell the assets. The assets are theirs now. Lastly, unsecured borrowing, the transferor has not divested itself of control through the repurchase agreement. Transferor divested itself of control through repurchase agreement. Again, same thing. You still have control. The manufacturing company is the transferor, still has control because they are only borrowing against the receivables. In this case, they got rid of the receivables, gave it to the collection agency, so they do not have control over them anymore. Secured borrowing, leveraging against AR. This is what we just talked about. Here's the accounting treatments for it. Not absolutely critically important, but conceptually, I just want you to know it. So we record a finance charge, just like if you're borrowing money. You collect the account receivable as normal. You record sales return and sales discounts as normal. You absorb bad debt expense. You record interest expense on the note payable that you're borrowing. Again, just like you're normal, like you're borrowing something. And you pay on the note periodically from collections. So as you receive your AR, you pay down that debt. This is, honestly, really not too out there. It's pretty standard on what you're seeing. And we also have our sales of receivables. This is where you're literally taking the receivables off your balance sheet, giving them to someone else. Now that AR brokerage company, or that it's called a factoring company, collections agency, effectively an AR brokerage company, they are now taking your asset of receivables and putting it on their balance sheet, and they give you cash for it. All right, so you transfer ownership. You record any amount retained by the transferee as due from factor. You record loss on sale of receivables. So that obviously you're giving it to them at a better rate. Like look at the one you had 100,000 of receivables, you're giving them 100,000, receiving 85, so that's $15,000 loss. But again, that might not be the end of the world, because maybe you would have gotten an even bigger loss because you wouldn't have collected from your actual customers. Records any component liability when appropriate. Not going to see that as much. Accounting for receivable transfers. So lots of different slides we're seeing on this. Don't want to beat it too much to death. Well, I did say I wanted to beat it to death, and I feel like I have done that. But take a look at this. I'm not going to go through it. It's not absolutely critical, but just another slide detailing how the accounting is done here. But nothing, there's much more pressing issues that we will go through.